Well, let's get started. Today we're going to continue on chapter 25 about short-term business decisions. We will see the other two major types of short-term decisions that the management has to make regarding the business. But before we get started, let's have a quick review of the last class. Well, in the last class, we talked about relevant information versus irrelevant information. And as I said, in order to make short-term business decisions, the managers should focus on relevant information instead of irrelevant information. That means, well, the managers do not have to consider the irrelevant information when they make short-term business decisions. Well, so what is relevant information? What are the two characteristics regarding relevant information? Two characteristics. Well, first, relevant information is the future data. And second, relevant information has to differ among different alternatives that the managers may take. Well, for example, as I discussed in the last class, for example, a business decides to purchase a new delivery trunk, and two different trunk models can be selected. Well, so in this case, if the price, the selling price, the sales tax, and insurance premium are different between the two models, this information is considered relevant because they differ and they are future cost to the business. Well, irrelevant costs, such as the cost of the current trunk, and also it is a kind of sunk cost, which are the costs that were incurred in the past and cannot be changed regardless of which future action is taken. Okay. Another point mentioned in the last class is that as you study these short-term business decisions, you keep in mind two cases in analyzing short-term business decisions. One thing, you need to focus on relevant revenue, relevant costs, and relevant profits. Irrelevant information, again, only clouds the picture and creates information overload. Irrelevant information should not be considered. Well, this is the first point. Second, use a contribution margin approach that separates variable cost from fixed cost. Okay, in the last class, we looked at the pricing decisions. We learned how business set regular price Okay, before talking about different pricing decisions, we learned about two types of business regarding the price setter. Setting the regular price of your product. One type is price takers, and another type is called price setters. Well, companies are price takers when they have little or no control over the price of their products. And companies are price setters when they have more control over pricing. And when companies is a price setter, their products are usually unique, which results in less competition. Less competition. Okay. And we learned about two pricing methods: target pricing and cost plus pricing. When a company is price taker, it focuses on target pricing. And when a company is the price setter, it usually uses cost plus pricing. Well, and lastly, in the last class, we learned about special pricing. A special pricing decision occurs when a customer requests a one-time order at a reduced sales price. So in this case, as a manager needs to decide whether or not to accept this order. The key is to look at the variable cost. If the expected increase in revenue is greater than the expected increase in variable and fixed cost, we accept the order. If the expected increase in revenue is less than the expected increase in the cost, we reject the order. Okay, so today we're going to look at how managers make decisions regarding which product to drop and how to make the product mix as well as sales mix. Well, deciding which product to produce and sell is a major managerial decision. Because of the limitation in manufacturing capacity or limitation in sales capacity. I mean, if the storage, the shelf space is limited in the store, then the managers must decide which products to display and sell. Also, the managers must decide whether to drop some products, departments that are not as profitable as desired. So let's look at how these decisions are made, beginning with some of the questions. Well, these are a list of the questions that the managers must consider when deciding whether to drop a product or business segment. These questions include: does the product or segment provide positive contribution margin? Will fixed costs continue to exist or not when the company drops this product? Third, are there any direct fixed costs that can be avoided if the company drops the product or segment? Will dropping the product or segment affect sales of such product or service? And lastly, what would the company do with the freed manufacturing capacity or store space? Well, it means if the company drops this category of products, the manufacturing capacity increases, or in other words, will be freed. So what would the company do with the freed manufacturing capacity is another consideration when management makes such decisions. So once again, we follow the two guidelines for short-term decisions. First, we focus on only relevant data. Second, we use a contribution margin approach so that the variable cost can be separated from fixed cost. Okay, earlier we focused on one of the smart touch learning company's product, the standard tablet. So now let's focus on two types of its product, both standard tablets and premium tablets. So this slide shows the company's budgeted contribution margin income statement by product, assuming that the fixed costs are shared by both products. So the first question is, does the product provide a positive contribution margin? Well, if the product has a negative contribution margin, then this product is not even covering its variable cost. So in this case, the company should drop the product. However, if the product has a negative contribution margin, then it is helping to cover some of the company's fixed costs. Well, in this case, obviously, we can see the contribution margin of premium tablets is negative. So obviously, as the management, you may want to drop the premium tablet. Well, but before you make such a decision, you need to consider more factors. One of the factors is the effect of fixed cost. Well, as you learned in the previous chapters, this company could allocate fixed costs in many different ways. And each way would allocate a different amount of fixed cost to each product. For example, fixed cost could be allocated using a traditional method with direct labor hours as the allocation base by using activity-based costing or by some other method. But in short term, many fixed costs remain unchanged in total, regardless of how they are allocated to products or other cost objects. So allocated costs are irrelevant. The allocated fixed costs are irrelevant except for any amounts that will change because of the decision, the nature of such decision that is made. So in this case, relevant fixed costs include two things. One, will the fixed cost continue to exist if the product is dropped? Two, are there any direct fixed costs of premium tablets that can be avoided if the product is dropped? So let's take a look at of the first case. Well, this slide shows the differential analysis of dropping a product when fixed cost will not change. Well, fixed costs that will continue to exist even after a product is dropped are often called unavoidable fixed costs. Unavoidable fixed costs are irrelevant to decision because they will not change if the company drops one type of product. Well, let's assume that this company's total fixed cost is 321,000. That is unavoidable whether the company drops the premium tablets. Also, let's assume this company makes the premium tablets in the same plant using the same machines as the standard tablets. So only the contribution margin the premium tablets provide is relevant. If the company drops the premium tablets, it will lose 90,000 contribution margin. So as you can see, one thing that we need to consider is the expected decrease in revenue. Well, a loss of revenue will result in a negative, it will have a negative effect on your operating income. So we have a pair of brackets in $230,000 here. And another thing you need to consider is the decrease in cost, specifically the decrease in variable cost. Because as I said, the fixed cost is unavoidable in this case. It doesn't change whether you drop this product. Well, the decrease in variable cost has a positive effect on the operating income. So, two effects, both on revenue and the decrease in variable cost, we sum up these two effects together, we have a negative $90,000. Well, let's see another case. Direct fixed costs will change. Well, in this scenario, instead assuming the company is manufacturing the premium tablets in a separate facility. If the product line is dropped, the lease on this facility can be terminated, and the company will be able to avoid all the fixed costs except $3,000. So in this situation, 92,000 of fixed costs belong only to premium tablets will be saved. Well, these would be direct fixed costs of premium tablets. So in this case, this amount of money, this amount of decrease in fixed costs should be considered relevant if the product line were dropped. So this slide shows operating income will increase by 2,000 if the company drops the premium tablet. Well, let's take a look in detail. In this case, the revenue will decrease by $230,000. Well, even though the revenue is decreased, the final operating income has a increase. Why? Well, because you also need to consider the decrease in the cost. Well, in this case, we have a decrease not only in variable cost, but also in fixed cost. Because if you drop this product line, the relative fixed cost can be avoidable. So 140,000 plus 92,000, that is 232,000 in total. That is your savings in the cost, the decrease of cost. Well, so the decrease in total cost is greater than the decrease in revenue. Well, in this case, it means it is, well, a better decision to drop the premium tablets. But in addition to fixed cost, the nature of fixed cost, we have some other decisions, other factors that we need to consider. Well, in the examples given so far, we assume that dropping one type would not affect the other type. But think about another case, for example, in a grocery store. Even if the produce department is not profitable, would the managers drop it? Probably not, because if they did, they would lose customers who want one-stop shopping. In such situation, the managers also include the contribution margin from other departments affected by the change when deciding whether to drop one type of product or to drop a department. Another example is a company that manufactures dining room tables and chairs. If the company drops the tables, there would be definite effect on chairs, as most customers want to purchase chairs that match this table. So management should also consider what it could do with the freight manufacturing capacity. Well, in the Smart Touch Learning example, we assume the company produced both standard tablets and premium tablets using the same manufacturing equipment. If Smart Touch Learning drops the premium tablets, could it make and sell another product using the freed machine hours? Is product demand strong enough that the company could make and sell of more standard tablets? Yes, these are all kinds of questions that the management needs to consider when make such decisions. So this is a quick summary of such decision. If the lost revenue is greater than the total cost savings, we do not drop such department or products. Otherwise, we drop it. Okay, product mix. The companies do not have unlimited resources. They have constraints that restricts the production or sales of products vary from company to company. For a manufacturer, like the smarter learning. The production constraint may be labor hours, machine hours, or available materials. For a merchandiser, the primary constraint is display space. Well, other companies are constrained by sales demand competition. If a company can sell the units it can produce, what products should the company emphasize? And for which item should production be increased? So these are the questions that the management need to consider when they make the product mix. Well, in one word, what is product mix? That is when a company is making or selling various categories of product. The company should focus on which kind of product. As you may guess, it can be the product that is more profitable. So let's return to our smartest learning example. Let's assume the company can sell all the standard and premium tablets it produces. But the constraint is machine hours. It has 19,500 manufacturing machine hours of manufacturing capacity. And the company uses same machines to make both types of tablets. So in this case, our machine hours are the constraint. Well, this slide suggests that premium tablets are more profitable than standard tablets because the premium tablets have a higher contribution margin per unit and higher contribution margin ratio. But in order to determine which product to emphasize, we cannot make the decision based only on contribution margin per unit. Instead, we should determine which product has the highest contribution margin per unit of constraints. Well, in this case, per machine hour. So to determine which product to focus on, we follow this decision rule. We emphasize the product with highest contribution margin per unit of constraint. Well, in this case, because machine hours are the constraint, the company needs to figure out which product has the highest contribution margin per machine hour. So let's assume Standard tablets require 7.5 machine hours to produce, and premium tablets require 10 machine hours to produce. So this slide illustrates the calculation for the contribution margin per machine hour for each time. Okay, in this slide, we can see the contribution margin per machine hour differs between two types, and standard tablets has a higher contribution margin per machine hour, higher than the premium tablet. So this slide proves that the company earns more total profit by making the standard tablet, multiplying the contribution margin per machine hour by the available number of machine hours shows the company can earn $500,370 instead of earning $438,750. But do you remember the assumptions that we made when making such decision? First assumption is the company's sales of other products will not be hurt by this decision, and the company can sell as many standard tablets as it produces. Okay, first, let's challenge the first assumption. How could making only standard tablets hurt the sales of the other products? Well, the retailers who display smarter learning tablets computer in their stores may want a choice of products so customers can compare and choose their tablets that best suits their needs. If the company produces only one type of tablet, the retailers may be reluctant to display this brand. And the second assumption is the company can sell as many as standard tablets as it produces. Okay, let's assume that the company had only budgeted sales of 2,400 standard tablets and has the capacity to produce 2,600 standard tablets. And now, because of the competition in market, it has a new budgeted sales volume decreased to 2,000. Only 2,000. the expected sales volume decreases to only 2,000, that means, well, the extra 600 standard tablets will not be sold because of the competition from market. Okay, if the expected sales volume decreases, the company should use the total manufacturing capacity to make only 2,000 tablets and use the freed manufacturing capacity to make another type of tablet, that is the premium tablet, even though its contribution margin per machine hour is a little bit lower. But if you use the freed manufacturing capacity to make another type, it will be more profitable because of the budgeted sales volume. So in this case, we can use 15,000 machine hours to make standard tablets and use the rest 4,500 hours to produce the premium tablet. Similarly, sales mix is applied to merchandising companies. Merchandising companies also have the constraints. For example, the display space is one of the most common constraints for merchandising companies. So the managers must choose which product to display. Well, let's take a look at this example. Let's consider a company that operates gift shop in the airport. Airport gift shops are fairly small, and the company has only 48 linear feet of bookshelves in each store. Well, the following chart shows the average sales price, as well as cost of hardcover books and paperback books. The sales price of hardcover books is $28 and $12 for paperback books. The variable cost for hardcover copies, it is $19.60. For paperback books, it is $7.20. So the contribution margin for each product is $8.40 and $4.80 respectively. So this part of the slide shows the total contribution margin with these place-based constraints. And we know the management has determined that each linear foot of bookshelf can display 10 hardcover copies or 20 hardcover copies. So the company can generate more profit per foot of shelving if paperback books are displayed. So the company should emphasize on the paper books, but the company should also consider the market. What do airport shoppers want? Well, in this case, the company can display twice as many paper books than hardcover. Well, the increased variety of titles displayed increase sales and inventory turnover, or will it lose the sales if only the paperback books are displayed? Other factors must be considered when making such sales mix decision. Well, the next, also the last type of business, short-term business decision is to make outsourcing and processing further decision. Okay, first of all, what is outsourcing? Well, many companies choose to outsource products or services. For example, a hotel chain may outsource its reservation systems. So this allows the company to concentrate on its primary function rather than purchasing and operating an extensive computerized reservation system. By outsourcing, the hotel chain is taking advantage of another company's expertise, which allows it to focus on its core business. Outsourcing decisions are often called make or buy decisions because managers must decide whether to buy a component or service, a component of product or service, or produce it in-house. Well, the heart of these decisions is how best to use available resources. Smart Learning Company is designing whether to make the casing for its tablet computers in-house or to outsource to another company, which is a company that specializes in producing casing for computers. Well, Smartest Learning's own cost to produce 2,400 casing is $23. Well, remember that. It's $23 per casing. To make it in-house, the cost is $23 per casing. If the company outsources this part of casing, the cost is only $21. So initially, it seems that the company should outsource the casing. Well, but the correct answer is not so simple because manufacturing cost per unit contain both fixed and variable components. So, in deciding whether to outsource, managers must assess fixed and variable costs separately. Some of the questions that the manager must consider include what? How do companies' variable costs compare with the outsourcing cost? 2. Are any fixed costs avoidable if the company outsources? 3. What could the company do with the freed manufacturing capacity? So let's take a look. How do these considerations apply to this company? By purchasing the cases, Smart Touch Learning can avoid all of the variable manufacturing costs. That is $15,600 of direct material, $7,200 of direct labor, and $13,200 of variable manufacturing overhead. So in total, the company could save $36,000 in variable manufacturing costs, or that is $15 per each casing. So that is this number divided by 2,400 units. That is $15 per unit. the company will have to pay the variable outsourcing cost of $21 per unit. That is to outsource the total cost divided by 2,400. That is $21 per unit. So based on variable cost, the lower cost alternative is to manufacture the casings in-house. But the managers must consider another factor, that is fixed cost. Okay, first, let's assume Smart Touch Learning cannot avoid any of the fixed costs by outsourcing. So in this case, the company's fixed costs are irrelevant to decision because the company would continue to incur 19,200 fixed cost. The company the company should continue to make this own case. But let's assume the company can avoid the fixed cost if it outsources this part of casing to another company. So this slide shows the differential analysis for outsourcing decision when fixed cost will change. So in this case, if the company outsources the 2,400 cases to another company, it can save $12,000 in avoidable fixed cost. So as you can see, in this case, if the company outsources the casings to the third-party company, it can save $50,400. So, a quick summary of outsourcing decision. If the differential cost of making the product is greater than the differential cost of outsourcing, you should outsource this part. Otherwise, you do not outsource this part. Well, now we know it is better to outsource. But the smartest learning has another three alternatives to consider. First, to use the facilities to make casings. Second, to buy the casing and leave facilities idle. Third, buy casings and use facilities to make the new product. Well, let's make a comparison here. Well, the first option, to make casings in-house, it can make the revenue of $48,000. And second, to outsource, it can make revenues for $50,400. But the last option is the least profitable option, because when you make new product, the expected from the new product is a negative value, because the net profit is negative. So if you choose the last option, the expected net revenue is lowest. Okay, the last type of decision, to sell or to process further. At what point in producing should a company sell its product? Well, many companies, especially in the food processing and natural resource industries, face such business decisions. The companies in these industries process a raw material to a point where before it is resellable. For example, a dairy processor pasteurizes the raw milk before it is saleable. The company must then decide whether it should sell the pasteurized milk or to process it further into other dairy products, such as reduced fat milk, the butters, sour cream, cheese, or other dairy products. Some questions that the managers must consider when deciding whether to sell or to process further include these three questions. 1. How much revenue will the company receive if it sells the product as is? 2. How much revenue will the company receive if it sells the products after processing it further? 3. How much it costs to process the product further? Well, consider one of the smartest learnings, sell or process further decision. Let's suppose that the company can sell its tablet computer or add a front accessible USB port to the tablet. The cost to add the USB port is $5. The cost includes the cost of modifying casing and the USB components, as well as the labor to add the components. Well, this feature is popular with customers, and tablets with this feature can sell for $20 more than the tablets without this feature. So this slide shows the differential analysis for this decision. So notice that the company's managers do not consider the other costs incurred in producing the tablets. If you can remember, in the previous slides, we have a 964,000 cost. That is the variable cost plus the fixed cost. So these costs here are the joint cost. So joint costs are the cost of a production process that yields multiple products. So in this case, the joint cost, in this case, the multiple products are the tablets without the feature and the tablets with the feature. Remember, the joint costs are sunk costs. So recall from a previous discussion that a sunk cost is a past cost that cannot be changed, regardless of what future action the company takes. Smart Touch Learning has incurred the joint cost regardless of whether it sells the tablets or adds the USB feature. So the joint costs are not relevant to the decision. And by analyzing only the relevant cost, showing in these slides, the managers see that they can increase profit by $36,000 if they add the USB ports. The extra 48,000 additional revenue outweighs the additional cost of the extra processing. So here is a quick summary of sale or process further decision. If the additional revenue from processing further is greater than the additional cost of processing further, we process it further. Otherwise, if the additional revenue is less than the additional cost, we sell it or do not process further. Well, this is the end of this chapter. So basically, you have only two principles to remember when you make short-term business decisions. First, you focus on only relevant information. Second, you use use the contribution margin approach that separates the variable cost apart from fixed costs. So in most cases, variable cost is always relevant, and in some cases fixed cost is relevant, and in some other cases fixed cost is not relevant because it doesn't change. So when you use these two approaches, you make business decisions regarding to our guidelines introduced in this chapter. Well, that's the end of this class. Do you have any more questions?